Welcome to Option Trades today. I'm Tony the Baptiste, and I've got a trade idea for you today. With low implied volatility, the pickings are slim on this January 17th, 2023. Let's take a look at what the market's doing first. Even the S&P's down around 5.5 handles. They've been pretty much unchanged for most of the day. Sunday, Monday, when the futures opened, they opened on Sunday, then they closed, and they opened again on Monday. They opened on Sunday up 8 handles. That's 8 points. Right now they're down 575. That's just over 5.5 handles. They opened again on Monday down around 8 handles. So we had a good 16 to 25 point high-low in the market. We went outside of that high today. We have not tested the low from last night. Nasdaq's up 2 and change, but you've got pretty much an unchanged market, but you've got volatility up 25 cents, maybe signaling that this recent up move in the market is getting a little long in the tooth. I don't know. We'll see. But let me tell you something. It was hard finding trades today where you had high IV rank. That's this column over here. I'll click on it 2 times to make it go in descending order. And stocks that didn't have earnings. So if I click on the earnings tab here, you'll see that all of the stocks that we like to trade, the Teslas, the Metas, the Qualcomms, the Apples, the Googles, they're all here, high IV rank, but also have earnings. One of those stocks that what I like to do is I like to try to find stocks that have earnings very close to expiration in February. If I'm going to stay in the February cycle, February has 31 days. I'd have no problem with you going to March, but as you go down this list all the way down, this is the fast movers I'm on right now. When you go down all this list, the last one is 3.7. If I were to change this, there won't be much difference here. If I change this to the hold on one second. Where's my liquid markets? Let's go down to, look at this. I can't even find where it is. There we go. High option volume, liquidity. There we go. If we go down here, there'll be a lot more stocks, obviously. But let's go down to the bottom here. You'll see that they're still all in March here. So I haven't been able to find a stock that doesn't have earnings in the month of February. And one that maybe doesn't have one in March, almost impossible to find that. But one that doesn't have earnings in the month of February that still has high IV rank. But I did find one stock, Roku. Let's take a look at it. And you remember I used to joke, they're in every TV. Let's take a look at Roku here. Look at this. IV rank, the IVX 5-day change, up a solid 10% over the last 5 days. Now, that's a large move, especially for a stock that's basically doing nothing to the upside today. Roku's going to have call skew to it ever so slightly. It has earnings 216, which is the day before expiration in February, as close as I could get to something that doesn't have earnings in February would be the day before, obviously. Let's take a look at what I'm going to look to do in Roku. We'll go to a chart real quick of it. Roku's had a nice rally with the rest of the market. Roku has a correlation of 0.72. Remember, correlation is found on the right side gutter of Tastyworks that I do not have on the screen right now. But it's a 0.72, which means a pretty high correlation to the overall market, meaning it should move the majority of the time with the S&P 500, which is what you're seeing here. Let's take a look at Roku on the option pricing itself. One unique feature that I found, since the IV rank is 31, relatively high for what we have on now, the IVX 5-day change, up 10%, real high for the last 5 days. What I did find was that when you have a stock that's trading right at the money, meaning $50, a solid strike, even though you have $5 wide strikes, you can go an acceptable amount of space or amount of dollars out of the money and still get a little bit of credit here. I'm going to go down to the 40 and up to the 60 just to show you something here. This is what we would call skew. I'm equal distance away, $10 away on each side. And to demonstrate the call skew without going to change one of my columns here to show you implied volatility, which you certainly could do. But you can see an equal distance away, the put's trading for around $1.30 and the call's trading for around $1.75. equal distance away. You've got a little bit of call skew. The equal distance away call is trading for more money than the equal distance away from the stock put. Now, how can you take advantage of this? Well, you could use a call ratio spread, might be a way to do some of this. Or if you're just looking to play a delta neutral trade, which is what I'm going to look to do, you can do something like what I'm showing up here, the 40-60 call spread, 40-60 strangle, excuse me. I was able to get filled at $3.04. It looks like that's a penny over the natural bid, so you should be able to get filled probably around 307 or 306 presently, with the stock down 91 cents. I think the stock was down around $1 when I put my spread on. Now, this is only going to use $1,237 in buying power. It's got that over 1 standard deviation probability of profit. That's why this green line is just outside that dotted line, which is the 1 standard deviation range that you can see here on Tastyworks. So I'm just outside that 68%, which is 1 standard deviation. Obviously, whatever you sell this for, that's the amount of credit you're receiving. In this case, it's going to be closer to 306 or 307. My delta is a -10 here. You'll look here. The equal distance call is 27 delta. The equal distance put is 16 delta. That's how you get in that little over 10 delta short position here. Again, going with my assumption of volatility being a little bit bid, maybe this market getting a little long in the tooth to the upside, but again, still delta neutral in my eyes, being $10 away on each side. The beta weighted delta, -2. Versus SPY. Now, for those people who don't have a margin account and have to trade in a IRA account or like that, you can certainly put on this trade, naked call, naked put in Tastyworks. I know you cannot do that in a lot of other brokerage firms, but you can at Tastyworks. But it's going to use around $4,000 in buying power, as opposed to the $1,200 or $1,300 it's going to use in a margin account. So what are some things you can do to kind of not only define that risk, but use less buying power? Well, you can go down, for argument's sakes, to the 30 put and buy one of those for every contract that you're selling of the 40 put. And you can go up to the 75 call. Now you'll be using, well, in a margin account, you'll be using less, but in a IRA account, you'll be using closer to that $1,300, $1,400 in buying power. You can go up to the 80 call. You'll be using closer to $1,700 in buying power, matching the buying power of around $1,300 in an IRA account. Really not changing the probability of profit at all. 1 tick here on the probability of profit. Of course, you are collecting a little bit a little bit less credit, because you are buying those out of the money wings here. All I tried to do was go to equal price for those wings, but it does allow you to almost put on twice as many contracts if that's something you wanted to do in an IRA account, or do the same one synthetic strangle here, and then go to another stock, since you just saved yourself, $2,500 in buying power, and put on another trade, which is what we would prefer you do. We always default to less contracts, more products, meaning more stocks, than more contracts and concentrated. Well, listen, I hope you enjoyed this little YouTube or podcast, or wherever you're watching this. Please do us a favor, help us keep the lights on here. Open, move, subscribe to the YouTube channel. Put your comments down there. Give me the criticism and also the likes. I appreciate those too. I try to answer everyone that writes something in. And open or move an account to Tastyworks, and do it today. No time like the present.